Good morning and welcome to Business Morning. I'm Chimeze Obi Iwagu. Well, let's begin with the morning briefing. The central bank's demand of a 65% loan-to-deposit ratio from local lenders is expected to renew a high level of non-performing loans in the banking sector from next year. The Chief Executive Officer of AfriInvest, Mr. Ikechioke, headlined this projection during the release of the firm's flagship report on the Nigerian banking sector. Let's take a listen.
Well, this year we titled it Beyond the Precipice, Pulling Back from the Brink. In a nutshell, we're saying the economy is not doing great. That's why we're saying we're beyond the precipice. And pulling back from the brink is really what are the key things we can do that can help that economy come back and reset itself on the path of sustainable growth and development. The banking sector itself, the dynamics are still positive. The momentum is good. We're seeing good momentum in growth of assets, also in growth of turnover and in profits. There are some early warning signs in terms of non-performing loans. And now with the CBN circular on the loan-to-deposit ratio, where they have to meet a minimum of 65% loan-to-deposit ratio by the end of the year, it's going to put more pressure on them to create risk assets, which would also further put more pressure on non-performing loans. So that's a worrying sign. The industry NPL ratio is around 8 to 9%. It's a bit down from last year, which was above 10%. But the banks are big boys. If they give loans, they should know how to manage those risks. But if you look at the overall Nigerian economy, what this report also encapsulates is that the economy is not doing great. Yes, we are 2.2% projected growth for the year 2019. Coming off just 1.9% in 2018. But with a population growth approaching 3%, you can see that we still have a whole lot more to do. If you then compare us to other comparable African countries, Ghana, South Africa, Morocco, Egypt, Kenya, you see across all those spectrum in terms of measures of development, Nigeria is now faltering. We're actually quite way below. Once upon a time, we used to compare ourselves to the Asian tigers or even to Western European countries. But today, when we even compare ourselves to Sub-Saharan Africa, there's a lot of work to do. So in coming up with the tagline, pulling back from the brink, we try to capture, the issues in terms of the critical imperatives that we can focus on that can pull this economy back on the right path. And we broke them up into 3 boxes. The first is what are the wrong things we should stop doing. The second is what are the right things that we should be doing, which we are not doing. And the last is what are the smart things that we should start doing on top of the right things, which will further turbocharge us.
Meanwhile, a former governor of the central bank, Professor Charles Soludo, has challenged Nigerian banks to take advantage of the African Continental Free Trade Area Agreement for the good of the country. Professor Soludo made the statement while commenting on the banking sector report released by investment banker AfriInvest, asking lenders to embrace disruptive change.
I saw the number put out there about the size of the assets. The banking sector assets. 42 trillion or something like that. Is that? Oh, I haven't looked at those numbers very recently, so I just had a quick check. And what struck me is actually that that's about 30% of GDP. And I screamed, wow. Well, when we started, just to put it in context, when we started, it was just 1.something trillion. So before the banking consolidation. So if you look at it from where we started and where we are, it's a sea change, massive transformation. But there is an important point to note, and that is that the total banking assets, without we say about their size and so on, it's just too minuscule. Huh? And that is probably, I'm just making a suggestion to you, maybe in subsequent ones, it would actually be nice to, of course, you recommend we are going to read the report, but let's actually also look at where we are, the banking, the depth of the banking system relative to, or even in comparison to African countries. Because I quickly just Googled and checked, even by banking, the ranking of countries by asset size as a percentage of GDP. And I was struck as how low we are on that scale, even by African standards. The countries as Cape Verde, Mauritius, Kenya, Senegal, even Ghana, and several others are way much higher. Now, that might have some implication about still the banking sector, financial system, and the kind of economy that we want it to be able to power. We had a dream of Nigeria becoming the Africa's banking and financial center. Now that we're actually integrating Africa to have an African continental free trade area, as it were, what kind of banking and financial system do we really need to be able to move the economy? It's the largest economy in Africa, no question. But the question is, what should be the next level for the banking system? And what should be the kind of disruptive change or changes that need to occur to be able to move the sector to that level that is able to power the Nigerian economy and increasingly African economy, because even our banks, their subsidiaries are all over the place. I understand even one of the banks in Nigeria, their total, look at their bottom line, probably accounted for more than 40% from their subsidiaries in and around Africa, as it were. I think that might be one way of pushing us in the direction of the further reforms and further changes, especially disruptive changes. I like the concept of disruptive change. You can repeat the same thing over and over and expect a different outcome.
Professor Charles Soludo, former Central Bank governor.